Hi guys, welcome back to the YouTube channel. I hope you're all well. In today's video we've got a slightly different format in that what we're doing today is running through an actual client case study. Something we've been working on with a high net worth client over the past couple of months now, from the initial advice, the initial tax structuring and review, to actually helping them get this structure set up in the most tax efficient way. So we've got quite a few facts that we're going to run through. I'd like to actually take some notes on this one just to make sure we get all the key details in and nothing gets missed. But essentially what we're working with is we've got a high net worth client. They've got a number of buy-to-let properties in their own name, married, a couple of kind of young adult children as well that are just about to go to university or just finishing their GCSEs. And essentially they've got a valuable company that they're looking at selling in the next couple of years. I think they're planning on selling it for about £3 or £4 million expected sale proceeds. And they've kind of come to us with all these different pieces and said, okay, Josh, what can we do here? Have I got the best structure owning these properties in my own name? Having this company that I've got that's massively valuable and is going to be sold soon, having that in my own name as well. Surely there's got to be some ways to reduce the taxes here. With this client, one of the first things that we talk about is what's your appetite to staying in the UK versus leaving the UK, because of course, you go somewhere such as Dubai or somewhere with no CGT. Well, that's one of the best ways to reduce taxes is if you don't want to pay taxes in the UK most of the time, if you just leave the UK, except for property and a few other main things. But when you're strictly speaking about a share sale, one of the best ways to avoid those taxes is to leave the UK. But in this case, the client doesn't want to leave right now. Their children are just going to university, or one or two of them were. They were just going to university. So as a result, they said, you know what, we don't want to leave the UK. We need you to do the best that you can with us being a UK tax resident. He'd also previously sold a company as well, so he didn't have his business asset disposal relief available, which ultimately meant that when he sells the company for, say, £4 million, there was a 24% CGT hit on that, around £1 million of CGT coming his way with the current structure he's got in terms of him owning 100% of that limited company, which he's planning on selling within the next 3 to 5 years. So with the properties in their own name, the first thing we look at is, well, what's the wife's income? Can we, especially when we're looking at income, one of the best things that we can do is look to equalise income, especially where the wife has low or no other income, which is quite often the case. It's so surprising because this is one of the first things that we check, because it's so easy to fix, especially when you're a married couple. Can we equalise shares? Can we equalise the property portfolio so that the rental income, the rental profits are being recorded in the most tax favourable way? So what we did here was, for those properties we actually formed a partnership. We were able to implement some of the income rights as well, some of the income from that partnership to the children, just to give them some extra money as well, get more money from that property portfolio off of our clients, in this case the father, off of his personal tax return, because he already had pretty significant other income from his main trading business, all of the dividend income that he got from that. So actually wanted to get as much off of his self-assessment and onto other people's where possible, because quite frankly he didn't need the money, and he was often giving his children money for university fees, living accommodation out of his own pocket after he'd paid taxes on it. So we were able to set up a partnership with him, his wife. His wife was actually able to get capital rights in that partnership. Capital was able to share in the capital ratio, simply because as they were married, no gain, no loss. All of the properties are unencumbered, so there's no SDLT to pay there, and there's no CGT because of that no gain or loss. Where you've got a partnership, you can't just give it straight to your children. You can't give them actual capital rights. You can't give them a capital share in that partnership, because that would give a CGT liability on yourself. But you can give them income from that partnership without actually making a CGT disposal. So we was able to put that in place. So you've now got a family investment partnership with the number of properties that they've got in there. And that is able to actually significantly reduce the amount of personal tax, the income tax that was being paid on our client's tax return, because now it's going to his wife and also to his children, who are members of this partnership. And it's important to mention here that with this partnership now being in place where it wasn't before, this obviously could be a gateway to incorporation at some point. But it's worth mentioning that you can't set up a partnership with the view of just incorporating it in a couple of years' time. HMRC, with obviously all the people that are pushing in this area for the property incorporations and how they're actually structured, it's now a lot harder, necessarily, not say harder, but it's a lot more risky to incorporate a property portfolio now, with several tax commentators highlighting the risk around the Schedule 75 for the stamp duty. And basically, if HMRC can prove that your main intention of doing this scheme or structure, such as setting up a partnership to incorporate it, is for the avoidance of stamp duty, they can shut the whole thing down. So of course, having this partnership for now is one thing that's absolutely fine, and you could incorporate in the future, but you need to make sure that you've got an actual commercial basis when you do that. It can't be, we're going to set up this LLP now, set up this partnership now and incorporate in 2 or 3 years' time, because that actually means that that's the main purpose of it. If you run the property partnership for a number of years and then you've got other commercial factors that you can genuinely prove, and not just saving tax being a factor in this arrangement, then you can incorporate and you can do it tax-free. So then what we did was we looked at the income requirements for the client and their family members and looked to see how we can extract further wealth from the limited company in the most tax efficient way possible. The company was making pretty significant profits, so there was a massive corporation tax problem to deal with. What we were able to do here was we were actually able to create positions within the company for the wife, for the adult children as well, helping with admin duties, social media management. Off the back of this, they were able to take a salary very tax efficiently from the company, and also the company was now able to make pension contributions for them as well to start building up that family wealth long term and actually reducing the corporation tax in the company now. This was a fantastic move and save, I think it's about £10,000 or £15,000 a year in corporation tax alone just by doing this small strategy here. And then the main thing that we did here was the share for share exchange to create the group structure. As we mentioned earlier, as soon as that company is sold in your own name, 24% tax, about £1 million in CGT going away. The client didn't want to move overseas, absolutely fine. So we set up this group structure for them using a share for share exchange. And what this allowed them to do is actually they had a commercial premises that they didn't want to sell, massively valuable bit of land, and they thought it was great rental potential for the long run. So they wanted to keep this. And you wouldn't have been able to do that if you didn't have this group structure in place. You never have a holding company structure. There's no tax efficient way to actually get that property out. So we put this group structure in place completely tax free by using a share for share exchange, getting clearance from HMRC, and working through all the requirements that are required by HMRC to make sure this is done effectively and tax efficiently. The end result is that the client has a group structure at the top and their main trading company at the bottom, which is going to be sold, and now a property investment company as well, all under this group structure. And even over the next couple of years, they can continue to buy more property tax efficiently using this group structure. And in 3 or 5 years' time, when they want to sell the trading business, they can actually sell that property completely tax free by utilising the substantial shareholders exemption. Broadly, the conditions for this is it's going to be a trading company. It has to own more than 10%. The group company has to own more than 10% of the share capital. But as long as you tick those boxes, that holding company can sell that company completely tax-free without any CGT at all. So that full $4 million that they might get, that will be coming into the holding company bank account without a penny of tax paid. And then to further assist with the inheritance tax planning and asset protection side of the structure, we were actually able to utilise that group holding structure that we put in place and make that as a family investment company, working with corporate solicitors, getting a trust set up as well, discretionary trust to help safeguard the assets that are intended to benefit these children, and there's actually grandchildren as well and great-grandchildren. You can do there's a very wide scope of beneficiaries that you can create share classes for to ultimately make sure that when you are creating this type of wealth, it is generational wealth and you can protect it. You can say exactly who's going to benefit from it, exactly when. You can put all of these details into it as part of, in terms of the trust deed and everything else, to actually create a tax efficient and secure and protected family investment vehicle. So we're able to utilise that company so that ultimately there were different share classes involved. You had capital, income, voting. We actually gave the wife, previously the wife didn't have any shares in the company whatsoever. Don't know why, but actually, explain to him the tax benefits of having his wife owning shares in the company, and also the inheritance tax benefits of having his wife owning shares in the company. So that was a very smart move for us to get set up there. And what that also allowed us to do was, when it comes to setting up that trust, of course, there's the shares with the future capital growth, the freezer shares, they're going into the trust, absolutely. So as those properties, ultimately the client's long-term goal was to sell the company, his trading company, and start investing more in property and just build a massive property empire in addition to what he's already had quite a substantial property empire in his own name, but he wanted to go that bit further. So what we actually did there was we put a kind of hurdle rate in. It's what it's called, the technicality, a hurdle rate into the articles of association when we're creating these shares, and ultimately all the future capital growth goes outside of our client's estate, in his wife's estate, and goes directly to the next generation. Some of the shares absolutely in the children's own name, and the vast majority of them going into a trust so that they're completely protected. And then on top of this, because when you put assets into a trust, basically you can do it tax-free as long as when you give the gift into a trust, it's not worth more than £325,000. So he could put £325,000 worth of shares in. His wife could also do the same. So that's £650,000 into that trust, completely tax-free and protected. All they've got to do is live 7 years for that to be completely IHT-free. Of course, at some point in the future, there will be the anniversary charges inside the trust, but the tax savings here was still very, very significant and far outweighed that. And now that's what we did for this client. So in terms of the total tax savings projected over the next 10 years, it was well in excess of 1.1 mil, taking into account the income tax, the inheritance tax, the CGT, and that much more. And guys, this is the kind of stuff that we're doing on a daily basis for clients, is working with them to run through exactly what they've got set up at the minute. Is it the best thing for them? 9 times out of 10 it isn't. There's always, I'm about to say always there, but 9 times out of 10 we can find significant improvements, whether it's just the odd tweak here and there, or in the case of this client, a massive improvement, a full restructure that ultimately saved them a significant amount in tax. And it's important to mention here, this client, they are happy to move overseas, but they just wanted to do so when their children left university. So we've actually optimized the strategy even more so that the assets they do have in their own name will be outside of inheritance tax, taking advantage of the new non-dom rules when they leave overseas, come to Dubai for 10 years. That's going to give further protections for the values of shares that they've got, and as they eventually deload their portfolio from UK investment property and pass that on to the next generation as well, overall it's going to be a very, very tax efficient structure. So there we have it, guys. There's some actionable insight as to what we actually do on a daily basis. Not quite your usual action-packed tax strategy, to the point type of video, more running through an actual case study. Did you find this useful? Let me know in the comments. I'd love to hear, because we can look to do these a lot more often, running through actual cases of actual work that we're doing in our tax advisory business. That's all for now, guys. I hope you found this video useful. Please do give it a thumbs up and smash that subscribe button. Bye for now.